Let's start with the big picture. Gold is not just a metal. It is not just jewelry. It is not just an investment. Gold is a monetary asset. It has no counterparty risk. It does not depend on a bank. It does not depend on a government promise. It does not depend on a digital ledger. For thousands of years, when financial systems were under stress, gold became the ultimate fallback. And historically, most people ignore gold until trust in the financial system starts to crack. Since 2022, central banks around the world have been aggressively buying gold. We are talking about roughly 1,000 tons per year for the last several years. That is not retail investors. That is not small traders. That is sovereign-level buying. When central banks behave this way, they are not speculating. They are preparing. What changed? The freezing of Russian foreign reserves after the Ukraine war was a turning point. When Russia was removed from the SWIFT payment system, it created a shockwave. For decades, SWIFT was the backbone of global trade settlement. Once a major country was cut off, every other nation started thinking, what if this happens to us? That moment planted a seed of doubt. Countries like China began exploring alternative trade systems. The BRICS alliance started expanding cooperation. Slowly, discussions around trade settlement outside the US dollar became more serious. And in that environment, gold becomes very attractive. Why? Because gold does not belong to any single country. It cannot be sanctioned. It cannot be frozen digitally if held domestically. It becomes neutral settlement collateral. This is where the idea of gold being monetized comes in. When large economies start treating gold as a strategic reserve asset for trade security, the demand changes character. It is no longer emotional retail buying. It becomes structural, long-term sovereign accumulation. And when sovereign demand enters a relatively tight market, price reactions can be powerful. Gold, moving from $2,000 to much higher levels in a short period, is not just excitement. It reflects a shift in perception. U.S. Treasuries have traditionally been considered risk-free. Central banks held them as core reserves. But if confidence weakens even slightly in that system, portfolio rebalancing begins. If treasuries are not fully risk-free, what is? For many central banks, the answer is simple: gold. This is why gold behaves like a crisis metal. Most of the time, people do not want to think about crisis. They prefer growth stories, tech innovation, bull markets, and stocks. Gold often moves quietly in the background, but when instability grows, gold wakes up. Now let's talk about silver. For years, silver has mostly been treated as an industrial metal. It is used in solar panels, electronics, medical equipment, and manufacturing. Because of that, many investors stopped viewing it as a monetary asset. But silver has a long monetary history too. It was money for centuries. Here is where the numbers become important. Global silver mine production is roughly 800 million ounces per year. Recycling adds about 200 million ounces. That gives us around 1 billion ounces of total annual supply. Sounds like a lot, but industrial demand consumes approximately 700 million ounces. That leaves only about 300 million ounces available for investors. 300 million ounces in a global financial system measured in trillions of dollars is extremely small. When silver trades purely as an industrial metal, that supply structure works. But if silver starts being viewed again as a monetary metal, even partially, the equation changes. Investment demand does not need to be massive to create stress. In a tight market, small shifts in demand can create outsized price reactions. We are already seeing signs of stress in major exchanges. Inventories in key hubs like the LBMA and COMEX have shown drawdowns. Delivery percentages in recent months have been unusually high compared to historical norms. When a high percentage of futures contracts result in physical delivery instead of cash settlement, it suggests that participants want the metal, not just paper exposure. That is important. If investor demand accelerates at the same time that industrial demand remains strong, silver's smaller market size can amplify volatility dramatically. Silver often moves faster than gold in bull markets, but it also corrects harder in downturns. This brings us to a very important principle. Gold leads, silver magnifies. In every major precious metals cycle, gold establishes direction first. Institutional money, central banks, and macro funds typically move into gold. Silver then follows, and often outperforms, especially when retail investors enter the market. The gold-silver ratio compresses when confidence in fiat systems weakens. However, silver rarely sustains strength independently. If gold were to correct sharply, silver would likely decline even more aggressively. That is why understanding gold's macro drivers is essential before making strong silver forecasts. Right now, gold's strength is being supported by several factors: central bank buying, geopolitical uncertainty, concerns over sovereign debt sustainability, and gradual shifts in global trade alliances. These are structural themes, not short-term headlines. Silver, on the other hand, is developing a supply tension story. Limited above-ground stockpiles combined with rising investor interest create a setup where price moves can become explosive if momentum builds. But again, the foundation is gold. If gold continues trending higher, silver will likely outperform. If gold loses momentum, silver's rally becomes fragile. We are in what appears to be the early stage of a broader monetary transition. It does not mean the system collapses tomorrow. It means trust is being recalibrated. And when trust shifts, capital reallocates. Now that we understand the foundation, central bank demand, monetary stress, and the supply tension in silver, it's time to look at how gold and silver behave in relation to broader financial markets. Many people assume precious metals move independently. They don't. Gold and silver are deeply connected to equities, interest rates, and investor sentiment. Understanding this relationship is crucial for any serious investor. One of the most overlooked factors in this bull market is gold's correlation with the S&P 500. Historically, gold tends to shine when risk assets show instability. But interestingly, in recent months, gold has been strong even while the S&P 500 remains near all-time highs. This may seem counterintuitive because we think of gold as a crisis metal. Yet gold has been rising alongside a strong stock market, showing that liquidity conditions supporting equities are also supporting precious metals. When money flows into financial markets freely, it can flow into gold and silver as well. But here's the catch. Correlations change. Gold can rally while stocks are high, but only to a point. If the S&P experiences a significant correction, precious metals will often initially fall in sympathy. Think of it like being tethered. Gold can run, but it is still connected to the broader market. The degree of the pull depends on investor psychology and liquidity at that moment. A 5% drop in the S&P may only pull gold down 2%, but that is enough to create sharp volatility. This leads us to the concept of the last battle, a term describing the moment when gold and silver finally decouple from equities. Until that happens, metals are influenced by the broader market, even if the fundamentals are extremely bullish. The decoupling occurs when fear dominates speculation, and capital moves from high-risk assets into hard assets like gold. This is the stage that defines the most explosive leg of a bull market, the so-called fear trade. It is not just speculation, it is a capital preservation move, where institutions and investors alike rush into hard assets for safety. Silver behaves similarly, but with one key difference. Its market is smaller, so price movements are amplified. Once gold signals strength, silver often outperforms. However, silver cannot sustain a rally on its own. If gold stalls or corrects, silver is pulled down more sharply. Think of gold as the big brother and silver as the little sister. Gold sets direction and silver magnifies the move. Understanding this hierarchy is essential. Silver is the accelerator, but gold is the engine. Another factor to consider is inventory and delivery trends. Exchanges such as COMEX and the LBMA are showing declining inventories. Physical deliveries in recent months have been unusually high. For example, January saw 49 million ounces of silver delivered, roughly 90% of contracts. February deliveries already surpassed typical percentages. These numbers suggest tight physical supply. If demand accelerates, both gold and silver could experience sudden spikes. Investors should monitor these trends closely because supply pressure can act as a catalyst in bull markets. Now, let's talk about mining stocks, the levered way to participate in this cycle. Gold and silver producers are uniquely positioned to benefit from rising metal prices. The best returns often come from mid-tier and smaller producers rather than the major names. Why? Because their operational leverage amplifies gains. A 10% rise in gold price may translate to 20 to 30% or more in stock price for a mid-tier producer. Larger miners tend to move more slowly due to scale and lower risk tolerance. Production growth, acquisitions, and disciplined capital allocation further boost upside potential. Some producers reinvest cash flow into expanding mines, improving margins, and paying down debt. These actions not only increase physical output, but also drive valuation multiples higher. For example, a company reducing debt and generating strong free cash flow may see its stock multiple expand, sometimes doubling or tripling the return potential. In bull markets, this operational leverage can be extraordinary. It's also important to understand risk-reward dynamics. Large, well-known miners are generally safer but offer slower returns. Mid-tier producers can deliver outsized gains but carry more operational risk. Smaller explorers are even higher risk but potentially offer exponential rewards. Investors need to align their portfolio with their risk tolerance. In a strong bull market, mid-tier producers often become the sweet spot, providing both upside and liquidity. Finally, let's summarize the market dynamics so far. 1. Gold leads, silver follows. Gold sets the macro trend, silver magnifies the move. 2. Supply tension matters. Limited above-ground silver stockpiles increase volatility risk. 3. Market correlation exists. Gold benefits from strong equity liquidity, but may initially fall during corrections. 4. The last battle defines the bull market. Decoupling from equities signals the start of fear-driven capital inflows. 5. Mining equities offer leverage. Mid-tier producers often outperform due to operational growth and leverage to metal prices. In Part 3, we will explore specific price targets, how investors can position themselves strategically, the role of gold-silver ratios, and a practical call-to-action strategy for your portfolio. We will also include a brief disclaimer for safety and clarity. Now that we've covered the fundamentals, market dynamics, and mining equities, it's time to focus on strategy. For anyone serious about gold and silver investing, understanding price behavior, the gold-silver ratio, and market positioning is key. Right now, gold is the anchor of the market. Silver is the accelerator. That means your first priority should always be tracking gold's trend. If gold moves higher, silver is likely to outperform, sometimes dramatically. If gold falters, silver will usually fall even faster. This hierarchy cannot be ignored. Let's talk about the gold-silver ratio, GSR. Historically, this ratio measures how many ounces of silver are needed to buy 1 ounce of gold. When the ratio is high, silver is cheap relative to gold. When the ratio is low, silver is expensive relative to gold. Right now, with gold trending higher and silver supply tightening, the ratio is compressing. That means silver could have more upside potential in the short term. Investors often look for these moments to maximize returns while staying aligned with gold's overall trend. price targets are always estimates, but based on current trends, geopolitical shifts, and central bank activity, gold has the potential to move significantly higher over the next 12-24 months. Silver, given its smaller market size and industrial demand, can amplify these gains. However, remember that volatility is much higher for silver. Sudden corrections can be sharp, so risk management is crucial. Mining stocks remain one of the best ways to leverage these trends. Mid-tier producers and select growth-oriented companies are positioned to deliver outsized returns. Look for producers with strong balance sheets, low debt, and a history of disciplined capital allocation. Operational growth combined with rising metal prices can create extraordinary upside. Larger miners can be part of your portfolio for stability, but for real growth, focus on mid-tier and high-quality smaller producers. Here's the practical takeaway for investors. 1. Follow gold first. It sets the trend for all precious metals. 2. Use silver as an amplifier. It benefits when gold is trending and can produce higher percentage gains. 3. Consider mining equities. Mid-tier producers offer leveraged exposure to metal prices. 4. Monitor supply constraints. Physical delivery trends, inventories, and global demand matter. 5. Be patient and disciplined. Precious metals often experience sharp swings. Ride trends but manage risk carefully. Remember, we are still in the early stages of what could be a historic cycle for gold and silver. Central banks are accumulating reserves, geopolitical tensions are reshaping trade systems, and the market is beginning to price in these shifts. Opportunities now may be far larger than what many investors realize. If you want to stay ahead of these trends, get regular updates, and learn how to position your portfolio for gold and silver, follow Gold Silver Scope. This channel focuses entirely on helping investors understand the metals market, track supply and demand, and spot the biggest opportunities before the mainstream catches on. By staying informed and disciplined, you can be prepared to make the most of this cycle. Disclaimer: this content is for educational purposes only and is not financial advice. Investing in gold, silver, or mining stocks involves risk, and past performance is not indicative of future results. Always do your own research and consider consulting a professional financial advisor before making investment decisions.